This video will discuss and estimate the weighted average cost of capital for a corporation. We'll use and discuss the weighted average cost of capital as a hurdle rate for projects in the firm with average risk in this video. We'll also use the weighted average cost of capital in capital budgeting in the next chapter. Before we go any further, let's get the big picture of what the weighted average cost of capital is, what this WACC is. WACC is a percentage. It's not a dollar amount, it's a percent. And the best way to motivate it would be as follows. Let's say you have a balance sheet, your own personal balance sheet, and you buy a house for $100,000. So that's an asset. You have liabilities and you have equity as an individual. And you borrow $70,000 in a mortgage to fund that. And you put down $30,000. And so your balance sheet balance is $100,000 on each side. And $30,000 is funding that, $70,000. So you're financing this house with 70% debt, which is a mortgage, and 30% equity. Now, if the mortgage rate was 4%, then that's your cost of borrowing money. You also have to account for the fact you have a tax deduction associated with mortgage interest. So it's really not going to cost you 4%. It's going to cost you, say, 4% times 1 minus your tax rate. Let's say your tax rate is 20%. And so this will only cost you 3.2% on an after-tax basis. Okay, so that's your mortgage costs, 3.2% after tax. And then here, for your equity, your down payment that you put on this house, let's say you had to pull this out of a mutual fund account or some account that earned 12% because it was vested in the stock market. So what I'm saying is that $30,000 has an opportunity cost of 12% per year because you could have invested that in the stock market, and those were your expectations for the return on that $30,000. So now, given this information, we can compute your weighted average cost of capital for buying this house. And it's going to be 70% here, 70,000 of 100, 70% times the 4 times the 1 minus 0.2 tax effect. So this is 0.8 overall right here. And then we have 30%, 30 out of 100, that's going to have a 12% cost. And so when we do the math, we get 2.24 for this overall term, and this term comes out to be 3.6. So the sum, 2.24 plus 3.6, comes out to be 5.84%. That's your own weighted average cost of capital with respect to buying this house. And so we're going to use the same technique on a firm. So a firm's going to borrow money, it's going to have some equity, it'll even have preferred stock, an additional item in here, and it'll be used to fund assets on this side for various projects. Could be buying a house, for example. Most businesses don't buy houses, but you can think of it as a possible investment. So that's where we're going with this. So the formula now, the formula for the weighted average cost of capital is this. For a corporation that we're going to do in this chapter, it's going to be the weight that you have on debt. In that case, it was the 70 here, times the cost of debt, in which case it was 4% here, 1 minus the tax rate, and that was 20% here. So the overall here is 0.8%. That's part of it. That's one component. That's the debt component. And then we have preferred stock, and that's going to be the weight that we have on preferred stock. And that's going to be multiplied by, the rate on preferred stock, dividend yield on preferred stock. And that's pretty straightforward, but I'll show it to you in a little later on how to calculate that. And then we have the weight on common stock times the return on common stock. And so that is the formula for this whole chapter. It's this guy right here. So what we need to do is we need to go through each one of these components and talk about them. First off, the sum of the W's have to add to 1. You have to account for all of the weights. You notice I did that up here because if you have $100,000 here, it's got to be broken up between these two components, and that's exactly what we did. So the weights have to add up to 1. And I would put them in decimal form when you do the math, like I did here, decimal form. And then I would put the percents, actual costs here, as a percent, not in decimal form. And so the math works out literally. Plug this into your calculator and this is what you're going to get. So now let me put in a word about those weights. As I just said, the weights add up to 1. That kind of makes intuitive sense, but you have to keep in mind what those weights represent. Those weights represent a target capital structure of the firm. Now, what do I mean by target capital structure? What I mean by that is firms try to determine what their optimal debt, preferred stock, and equity will be for the firm. What do I mean by optimal? Well, they have the right amount of debt, the right amount of equity, and the right amount of preferred stock. So the idea is that if the firm reaches its target capital structure, it will reduce the costs of financing for the firm. And if you can optimize your weighted average cost of capital, then you're going to be in really good shape. It means your business is running pretty efficiently from a financial perspective. So those weights are target weights that you have to keep in mind when we're doing this analysis. So now we need to ask questions, where does RD come from? Well, that should look kind of familiar, and I'll go over it. And then where is RP, the cost of preferred stock? Well, that should look kind of familiar, and we'll go over it. And you know, what is this guy here, the cost of stock? Well, that should look kind of familiar, but I'm going to go over it. And so, you know, you've seen a lot of this, but we're going to put it all together in this formula to come up with the cost of capital of a firm. And like I said, this weighted average, because it's weights, cost of capital, there's the costs, will be used as a hurdle rate. A hurdle rate meaning you got to make that rate or more to accept the project. And then this weighted average cost of capital will be used in a later video for discounting cash flows of a project. So we're going to have uses for this concept. So let me start with an example before I go any further. And it's a rather detailed example because it'll cover this entire formula. So here's the information. Let's say T is 40%. That's the tax rate. Debt is 15-year debt maturity, 12% coupon, and that's a 12% per year coupon. The price of debt is bonds are $1,153.72 because you can get that right off of an exchange, for example, a bond exchange, or off the internet, and you always know what the price of your bonds are, so that's no mystery. And we're going to use this to calculate RD. And then what we need to do is we need to look at preferred stock. We need to calculate RP. And the information here is that the dividend yield is 10%. And it's 10% of par value. And the par value of the preferred stock is $100. And the price of preferred stock equals $110.10. Okay, now what we need to do is we need to look at RS, the cost of stock. What is the cost of equity, in other words? And I'm going to say, look, we have a beta of 1.20. We have a risk-free rate of 7%. We have a market risk premium of 6%. We have dividend this period, you're just paid $4.38, growth rate of 5%. And this is screaming right here. This is screaming CAPM, capital asset pricing model, because it's the information you plug into the capital asset pricing model. And then one other thing I'm going to give you, because there's various ways of calculating RS. There's more than one way. And one way is called the bond yield method, the risk premium on a bond yield. So what I'll give you here is the bond yield risk premium is 4%. So this is what's given. Okay, so all the blue is given information. Let me change colors so it won't get mixed up. Now, given this information above this black line, how do we go about computing this formula right here, this guy? Okay, like I said, we need to calculate this guy, we need to calculate RP, we need to calculate RS. So let's go through it. First, we need to know what RD is. RD is the yield to maturity. It's the cost of debt. And so we have a bond that has 15 years maturity, which means it's 30 semi-annual periods. And that equals N. So N is 30. The future value is going to be $1,000. That's the face value you get back from the bond. The payment for the bonds are going to be the coupon of 12%, chopped in half to get it on a semi-annual basis, times the $1,000 face value of the bond, $60 per semi-annual period, per period here. The present value is minus 115372. That's the price of the bond today. And so what we're going to do is keep track of these signs here. We're going to put the future value. We're going to get $1,000 back. We're going to get $60 from this bond. And we have to put a negative sign in, so we have to pay for the bond, so to speak. And so that's $1,153.72. So when we crank this out and we say compute I/Y, what do we get? We get 5%. But be careful, that's on a semi-annual basis because everything here was done semi-annually. So just multiply it by 2 and it's 10% annually. And it's important to remember that all the R's, RD, RP, and RS are all on an annual basis, which means the weighted average cost of capital is on an annual basis. Okay, so let's move forward. So this is equal to RD right here. Now, what about RP, the cost of preferred stock? RP, if you recall, equals the dividend for preferred stock divided by the price of preferred stock. This is going to be $10 because it's 10% of $100 par. So the dividend per year is $10. The price is $111.10. And so the price of preferred stock is 9% annually. And this dividend yield is on an annual basis. This is on an annual basis, so this is on an annual basis. Okay. Now what we need to do is we need to calculate RS. And here's where things get a little muddy because there's several ways to calculate RS. And we've seen two of them, by the way. We've seen them. And so let me show you the methods. One would be the capital asset pricing model, where RS equals the RRF, the risk-free rate, plus the market risk premium times beta. Remember, this is the expected return on the market minus the risk-free rate. The problem gives us this number right here, the 6%, by the way. So we don't have this, well, we do have the risk-free rate. That is 7%. Let me make sure. In my notes here, yep, this is 7. But we don't have this number. We don't need it because we've been given the market risk premium is 6%. So therefore, if we use the capital asset pricing model, this is 7 plus 6 times 1.2 beta. And what this means is RS equals 14.2%. Okay, 14.2%. The other way we can calculate this is by looking at and rearranging the constant dividend discount model. And we say RS equals D1 divided by P subscript 0 plus G. All I've done here is taken this formula, the value of stock with constant dividend growth, and rearranged it and solved for RS. Okay? And that's this formula. And so when I use this formula, what I get is $4.38 times 1.05. That's last year's dividend times 1 plus G, the growth rate of 5%. So be careful, because you need D1 here, next year's dividend, and you were given last year's dividend. So just grow the dividend. No big deal. Now, one thing I haven't given you, and I should give you up here, is I need to tell you that the price of stock, let me put it in blue for you. The price of stock is $50. I should have given that to you right up front. That's okay. So we have it now. And so now this is going to be divided by 50 because I'm using this number here. And then the growth rate is 5%. And so therefore, RS is 14.2%. Oh, that's convenient. It's the same number. So I'm showing you two different ways of calculating RS. They should be consistent. But often, if you make slightly different assumptions from one model to the next, you'll get different numbers. And if you get different numbers, you just take an average of these numbers, as I'll show you in a minute. Now, the third method to calculate RS, you're not familiar with. And it's but it's pretty simple. It's going to take the bond yield that we have, RD, and which is the yield to maturity, by the way. So it calls it bond yield, but that's RD, which is the yield to maturity, plus a risk premium. And that was given at 4%. And we calculated the yield to maturity to be 10%. So therefore, the sum of these two numbers is 14%, which is pretty darn close to these two numbers above. So as I said before, you're going to take an average of these. 14.2, 14.2 plus 14. Divided by 3, we get 14.133% as RS. So what this, by the way, what this is telling you is that you can think of the cost of stock, the cost of equity, as being the bond yield, right, plus risk premium for the fact that stock is riskier than bonds. And so you're somehow going to have to be given this risk premium, and it is given to you, and so it's an easy calculation from there. Let me pause for a minute and address a couple of issues around calculating the R's before we compute this weighted average cost of capital. First off, when we looked at the bond, notice that we used the yield to maturity and not the coupon rate. The coupon rate is set when the bond is first issued because these are fixed income securities. So if the bond was issued maybe 10 years ago, it could have been issued. It was issued under a different interest rate environment than today. And so whenever you look at a bond that exists right now, it could have been issued quite a long time ago. Interest rates may have changed, so the coupon and the yield to maturity could be quite different. In this case, it's a difference between 12 and 10%, which is fairly significant, but it could be even bigger than that. The difference could be even larger. So keep that in mind. You want to use the yield to maturity. The other thing you need to consider is that there's a ranking associated with these R's due to risk. And what do I mean by that? Well, I'll show you. RD times 1 minus T should be less than RP, the rate on the preferred stock, which should be less than the return on common stock. So common stock should have the highest rate of return. The middle rate of return should be RP, the return on preferred stock, and the lowest should be the return on debt. Now this was 14.13%. This is 9%. And here you have to be careful. We use the yield to maturity of 10%, but companies get a tax deduction for their interest expense. We need to consider that. And when we do that, we get, here's point 4, we get 6%. So 6% is less than the 9, which is less than the 14.13. So we're safe. The point is, all of these returns are after tax. You can't deduct the return from dividends or preferred stock on the income statement. You won't find dividend expense, for example, on the income statement, but you will find interest expense on the income statement, and there'll be a tax benefit associated with that, and it's T. That'll be the tax rate. So therefore, after-tax cost is 6%, 9, and 14, and everything works. It's simply a check to make sure that you've got the numbers right. Now, for the most important part of this little sidebar. It's this. Why does that ranking even exist? Why is debt lower than preferred stock, which is lower than equity? It has to do with risk. Common stock is the riskiest securities of the firm. That should have the highest rate of return because investors demand a high rate of return if it's risky. Preferred stock is in the middle, so that should have a smaller return than stock. And the debt is a little less risky than the preferred stock. So debt has the lowest amount of risk, and it's at the bottom of the ranking. Therefore, the ranking has to do with risk and the demands of the investors who buy the debt, the preferred stock, and the common stock. Now let's get back to calculating the weighted average cost of capital. So now what we have to do is let's just literally, and this is where we call in finance plug and chug. Let's actually just plug and chug these numbers in, and we're going to compute this guy. And we already know that the firm's target capital structure is 30%. This is going to be 10%. And this is 60%. And we know that this is 10%. And we know the tax rate is 40% that was given. And we know this RP we calculated earlier to be 9%. And we just calculated this to be an average of about 14.133%. So we just literally plug the numbers in and let's add them up. It adds up to 11.18%. That's our weighted average cost of capital. 11.18%. And what that assumes, by the way, it assumes that we use just retained earnings in computing RS. We calculated this RS number, the cost of equity. And what we did is we assumed that we're using and funding these projects that we're going to evaluate based on the cost of retained earnings. But sometimes you want to invest a whole lot of money in a given year, and you're going to run out of retained earnings in which to use, which means you're going to have to float stock, meaning you're going to have to issue new stock. And when you issue new stock, you run up against flotation costs. And when you run up against flotation costs, what that means is you're going to have a higher RS. This is going to go up, and that's going to cause your weighted average cost of capital to go up. So where we are now is let's cover flotation costs and see how to work them into the model. So we're going to assume F is flotation cost. That's their notation. We're going to assume it's 15% flotation cost. That means the investment banker is going to take 15% off the top and give you 85% of the proceeds associated with an issuance of stock. And so we need to work that into our math. Well, that's actually not that hard because it's going to be RS 1 plus G. Remember, this is the dividend times 1 plus G. This is D1 basically right here. Yeah, that's D1. And we're going to divide the whole thing by the price. Remember, we did the price, but this time we're going to subtract out that flotation cost. So this ultimately results in a price that's only 85%, or the proceeds, I should say, 85% of what this actual price is, given that flotation costs are 15%. And then we need to add the G here. So when we do the math, it's 438 times 1 plus 0.05 divided by the price of $50 that we use minus 0.15 plus the 0.05 growth rate. And that comes out to be 15.82%. And so now our new weighted average cost of capital with flotation costs will be same numbers we saw before for much of this, with the exception of one change. There it is. You can put percent signs here, you can put percent signs here. Notice my weights again. Check your weights are always adding up to 1. And so I plug that number in. And now I get a weighted average cost of capital of 12.19% versus the 11.18% I computed right here. So this is with flotation costs. This is without flotation costs. Now, when do you use this? Well, that's a tricky question, but basically we're going to say is, look, if you only have a small amount of projects in a given year and you don't have to issue any stock, then this is your cost of capital. However, if you have to issue stock, then this is your cost of capital, because you got to pay that investment banker this 15% here, and it has a cost to it. As you can see, the weighted average cost of capital goes up. Now, before I close this video, let me cover a couple of items with respect to the weighted average cost of capital. First off, keep in mind that these weights are based on market values. And so they're not based on the book value of debt or preferred stock or common stock. Because, the common stock that's on the books could be 30 years old, could be very small compared with the market value of the stock is today. And so when you look at a balance sheet and you look at liabilities and equity here, and then you're going to have preferred stock. In the example we just covered, bonds were 30%, preferred stock was 10%, equity 60%. So if the market value of the firm was 100 and the assets were worth 100, then this would make sense. This is all based on market values, not book values. So this would mean the value of the firm based on market values is $100. The other thing to keep in mind is these weights are what we call targets. The firm has a target capital structure of 30%, 10%, 60%. 30% debt, 10% preferred stock, 60% equity. Now, in theory, what happens is every time they issue stock or debt or preferred stock, they should do it all at once in a little bits at a time, so that then you keep these weights approximately 30, 10, 60, but that doesn't really happen in reality. In reality, the company may issue a lot of common stock at one point in time, and later on issue a lot of debt, and then at another point in time issue a lot of preferred stock. But over the long run, it's targeting a 30, 10, 60. So keep that in mind. The weights are market values. The W's and the weights represents the target capital structure. The other thing to keep in mind is that the RDs, and here the adjusted RDs for taxes, and the RP and the RS, this represents the marginal cost of funds. So we had a 6% cost after tax for debt. That means if you issue $1 more of debt, how much is it going to cost you? 6% or 6 cents. If you issue another $1 of preferred stock, how much is that going to cost you? 9% or 9 cents. If you issue another $1 of common stock, oops, let me get that 9% in there. Now if you issue another $1 of common stock, you're going to have to pay 15, come back up to here, 15.82% if you issue common stock. If you have to utilize another dollar of retained earnings and not issue any common stock, then your cost will be 14.13% for this item here. So without flotation costs and with flotation costs. So this weighted average cost of capital, it's on a marginal basis. Now I just cleaned up the screen, and let me ask a question and drive home the idea of the target capital structure as being market values of the securities. So again, we have the balance sheet and we have bonds of 30, preferred stock of 10, and equity of 60. Let's make them thousands, a little more realistic, and we can work a little better with the numbers if that's the case. So we have 30,000, 10,000, and 60,000, and the whole balance sheet is $100,000 total. Now the question is, how many bonds are outstanding? How many shares of preferred stock are outstanding? And how many shares of common equity are outstanding? We have the ability to answer those questions. And I'll do it in purple here. We know that the price of these bonds per bond is $11.53, and the price of the preferred stock is $111, and the price of common stock is $50. So why don't we just divide the 30,000 by the 1153, divide the 10,000 by 111, divide the 60,000 by 50, and we end up with 52 bonds outstanding, 90 preferred shares outstanding, and 600 common stock shares outstanding. And so that's what makes up our target capital structure, and it's consistent with the fact that we're using market values for the weights.